I just wanna feel good every day. I wanna wear a smile upon my face. I wanna feel the joys of the day. I wanna feel alive in every moment. Said I won't waste time on feeling blue. I won't waste time on things I cannot change. I'm gonna live this day as best as I can, doing everything that feels right, singing la 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 la, la 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 la, la 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 la, la 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 la. La la la. I wanna hear the laughter of a child. I wanna feel a hug from a loving friend. I wanna hear I love you every now and then. I wanna show somebody that I care. 'Cause feeling good is a choice that we all make. Just like a smile, a small effort you make. I love to feel the newness of a brand new day. Happy to be alive today, singing la 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 la, la 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 la, la 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 la, la 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 la, la 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 la
Great. Good morning. Good morning, everybody. Thank you for the lovely music, Pendulu. That was absolutely fantastic. I feel energized for this session this morning. Welcome, everybody. I hope that you had a good rest and that you spent some time with your family. You know, yesterday I wanted to go to Home Affairs to pick up my ID, and somebody says, because for the first time my diary was nice and clear on a Monday, and somebody says, but Anne-Marie, Human Rights Day, you know, you won't find anybody anywhere. But and this morning my daughter went, and they still queuing. So I'm quite happy to be here and spend the morning with you. We have a fantastic program for you today. And I think the first up will be Old Mutual Corporate. We're going to talk about asset allocations and solution investing, the impact of the new 45% maximum in foreign assets. And I said to Urvesh this morning, Desai is going to be our presenter. For some or other reason, I've just totally missed this. I don't know. Maybe I was in hiding. I'm not 100% sure. But he's going to share with us, you know, all the ins and outs of this change and how it affects the way that you need to think and the kind of conversations that you need to have in your boardroom. So I hope by now you know the drill. At the bottom of your screen, there's a question and answer little icon button. So as we move through the presentation, please just type your questions there, and we will allow an opportunity to answer. There's also a chat box. I usually say, you know, that is for communication with the staff behind the scenes. If you want to just, but if you type a question there, we will also make sure that we have a look. We're also going to, if there's time permits, allow you to raise your hand if you have a question or two, and you can maybe then just address Urvesh directly. So thank you very much. Sit back, relax. Well, I'm not sure whether we will be able to relax, Urvesh, because this is quite engaging and a topic. but please, the floor is yours, and we are looking forward um, for you to educate us today on this new development. Thank you so much.
Thanks, Anne-Marie. Appreciate that. I'm just going to get my slides up and showing. So yeah, morning to everyone, and yes, the music was actually quite nice and energizing. So hopefully I don't now put you all to sleep. But as Anne-Marie said, it's actually this change that I'm going to be talking to you about. The Minister of Finance recently announced this significant relaxation in our foreign exchange regulations, right? And it was actually a subtle difference that made a huge difference to the impact of the regulations, in that what it used to be is it used to be the case where investors could allocate up to a maximum of 30% globally, and then separately allocate up to 10% in Africa, right, outside of South Africa. And the reality is this maximum 10% was really fully utilized, if utilized at all, because of illiquidity and difficult to get investments in Africa. But now what the rules have done is the rules have been changed so that 30% plus the 10% coming to 40% invested outside South Africa, theoretically, as a maximum. They took that and then made a maximum of 45% globally now. But they, in the wording of the regulation, there's no requirement to invest a portion of that 45% in Africa, right? So this means that for investors, where you could have taken up to 30% and invested globally in markets like the US and Korea and Japan, etc., you can now invest up to 45% of your portfolios in global assets. So it's a huge change. It's up to 50% more assets that you can invest offshore and invest globally now, right? So hopefully I'll share a bit of information and insight into how we're thinking about this and how you can think about it. It's a big decision with big consequences, right? And primarily the consequences come through returns in the portfolio, and that comes through the currency exposure. That's the key factor influencing this decision, right? So this is what I'm going to be talking about today. Brief introduction to me. I'm with the Old Mutual Investment Group and the Macro Solutions team. Been investing globally and locally for a very long time. And here's a pro tip. Always keep in your back pocket a picture of yourself that is slightly thinner and slightly better looking than what you are presently. So that's why I've got this one up here. But yeah, I've been looking at global investments, investing globally for South African investors for quite a while. And there's actually, yeah, I've often heard from investors, and particularly, from retail investors, talking to you about when they want to invest offshore and when they want to stay in South Africa, and it's usually at exactly the wrong times that they want to do this, right? But just a quick rundown of the agenda today. I want to start off with some basic conceptual stuff, right? But I think it makes an important point about diversification. I'll then touch on the standard thinking of how global exposure impacts the total portfolio outcomes, and then add a bit of a current perspective on this. Then I'll talk to how Macro Solutions are thinking about this change, and I'll share a few thoughts that could be useful for your thinking about this, right? Now, we've all heard the standard one-liner, diversification is the only free lunch. We all know or have been told that diversification makes sense. But I wanted to show conceptually how diversification works, right? I've always had a preference for thinking in pictures, and I think it's important to understand the concept first before you get bogged down in the detail, all right? So, and now maybe because it's just more top of mind, I thought I'd start by getting us to think a bit about global equity and global equity managers, right? So let's say hypothetically we know a global equity manager that's a value type manager, an imaginative unimaginatively named manager A. But if we take this manager's performance, right, and we compare this manager's rolling performance over time to a standard global equity benchmark index, let's say the MSCI All Country World Index, in this case, we all know from experience that this performance over time, there's going to be ups and downs in the manager's performance, right? Alpha can be lumpy, and managers can outperform at times and underperform at others, right? So this is basically just a conceptual graph, simply showing the rolling alpha of this manager through time, right? And you can see that the manager's performance fluctuates around a positive average performance. That's the dashed line in the horizontal line in the graph there. And that's an important point, right? So while this manager's performance can be up at times and down at times, and even underperform the benchmark where the line is going below the horizontal axis, on average, the manager has positive outperformance, right? So this is a good manager, and we've gotten some good advice to invest in them, right? So that's kind of the concept I'm setting up, right? And then I want to expand that concept a little bit by saying, now let's say we know another global equity manager, right? But this one is a quality style manager, right? And they're named Manager B, probably the same marketing company that named Manager A. So now here we show the brown line, right, which is meant to represent the quality managers rolling outperformance of the benchmark through time, right? Now, I've shown the quality managers outperformance also fluctuating around an average, sometimes good, sometimes bad, but still fluctuating around that positive average outperformance. And you see the dashed line there for manager B's average performance, right? Now, you can see a couple of things that I've done here stylistically and by construct with this conceptual graph, right? The pattern of the quality manager's outperformance is almost exactly the inverse of the value manager's pattern of outperformance. The drawing, shows pretty much an inverse correlation, or a correlation of -1, right, for the conceptual value manager and quality manager. Now, admittedly, this is exaggerated, right? But it's not terribly far from the truth. Value and quality, the kind of payoff profiles, do tend to often be negatively correlated. I've always said value companies aren't these wonderful companies that somehow no one has managed to spot. They're usually companies that have had some trouble, something went wrong, too much debt or a failed product line, or regulation is impacting the company, something that has caused people to not want to own this company, and that's why it's so cheap. So value companies tend to be more risky, and hence their performance is the opposite of quality companies, which tends to be more defensive and less risky. Now, because of this, potentially, I've also shown the average quality manager performance is slightly lower than the average value manager performance, right? So value has higher returns than quality because of that higher risk that investors are taking on by investing in these companies. And this is also something that we see in the historical data when we look at value and quality returns, right? So I hope I've kind of set this concept up quite nicely, right? So now, let's say we had great advice and invested in both these global equity managers, right? What would the outcome be like? And this is the answer, right? This, I don't even know what color that is. It's blue or turquoise line there. What we would have received, right, if we invested in both these managers together, is a much more smoother outperformance outcome, right? This is because in our admittedly exaggerated example, the highs and lows of the managers were occurring so that they canceled each other out, right? So that's the first important point about diversification. When combining investments that are less than perfectly correlated with each other, where there's a difference in their performance pattern, the combined outcome when you combine these investments is a smoother outperformance outcome, That's an important part about diversification. And there's a second important point, right? Remember that even though the highs and lows were, almost opposite each other, their patterns were different or uncorrelated. Both managers still had average positive performance, right? So when you combine these patterns, you don't get zero, but you get the average outcome in a smoother pattern, right? So that's an important point. Now, you're probably wondering why on earth are we talking about global equity managers and different styles in an asset allocation talk? But here's the point. In the same concept, right? Why don't we replace the value manager with SA equity, as you see? Now, I've just done the same green line, but I've said that the green line is SA equity, right? And the green line now is showing you the outperformance of SA equity compared to inflation, as an example, right? And what I've taken the brown line to be is showing you the outperformance of global bonds, right? Say, to again, compared to inflation, right? Now, again, here I've chosen these two examples deliberately, as SA equity and global bonds tend to be uncorrelated or even negatively correlated, right? And that's why you can see the pattern of that outperformance almost, diametrically opposite to each other, right? And again, when we blend these less than perfectly correlated investments and asset classes together, we achieve a smoother outcome for the portfolio, right? Now, why is this important, right? You're getting less wild swings in performance, and ideally, right, meeting your return requirements more frequently. And these are very useful outcomes for investors, right? You have less chance of investors panicking out after a round of bad performance, or being sucked in after a round of extremely good performance, right? And ideally, in this kind of environment, the compounding works better when the returns are smoother, right? So, after that long rambling discussion on diversification, what was the point, right? So when we're talking about investments and asset classes, there are two things that are very important to the diversification discussion, right? One is the average performance of the asset class, right? What returns are being achieved? And two, how does this return emerge? What is the pattern of this performance, right? Is the asset class correlated with other investments and other asset classes, or is it not correlated, uncorrelated, perhaps negatively correlated? And then most importantly, and this is the one that is often overlooked, how are these characteristics changing through time? Because they do change through time, and it's not a static behavior. Sometimes often, we kind of assume that the behavior of asset classes and investments are static, but they aren't. Markets and asset classes are constantly changing, and so too are their characteristics, right? So to invest appropriately, we must be aware of this, right? So, we all know, and maybe because of our past coming from a space in South Africa where we couldn't invest any assets offshore, we're all well aware of the benefits of investing globally, right? And we all know the common wisdom that why investing globally is a good idea, right? First one is there are tons more companies globally, more industries that one can invest in, more innovative companies, better quality companies and countries with better prospects. This is one space where there's ample space here for the SA pessimists to have a field day. And one can also say for security, right? One wants to potentially be invested in hard currencies. So that's also an exposure that you can get by investing offshore. And then the other one increases diversification. We've spoken a lot about that already. Don't put all your eggs in one country. Then number three, there may be potential for much better returns globally than there are here in South Africa. South Africa's growth has not been wonderful over the past 5 to 10 years, and prospects compared to what's available globally are not amazing in terms of our economic growth. So, can we get better returns offshore? And then finally, there's also, the argument that it's lower risk, right? And there's also this thinking that investing globally is less risky than investing in SA. And this is, again, a space where the naysayers have a field day, right? So this is the standard thinking and the standard wisdom about investing globally. And what I thought I'd do is I'd just add a bit of current perspective about this thinking, right? So industry exposure, right? It's hard not to see that globally there are just a host of other industries that we just can't get exposure to here in the South African market. So if we think about the GICS classification, and we know this classification is not perfect, but using it as a model, we only have just over half the number of industries that are available for investing globally. In SA, we've got about 38, and globally, you've got 69 industries. But this also, just this number doesn't talk to the depth of the investment you invest. So, while we may have 38 industries, we still have a lot of concentration in particular sectors in South Africa. And in South Africa, in particular, it's financials and mining especially, right? And where we don't get a lot of exposure to in South Africa, if any, is items in the tech space, semis, tech hardware and software, and also kind of growth in areas like pharma and biotech. There's a massive dearth of companies like this in South Africa. So from a broader exposure perspective, it's hard to argue with this thinking that you do get broader exposure by investing globally, right? And then, the other item we spoke about was diversification, right? And we spoke about this earlier, or the pattern of performance, right? Now, what this graph shows you, right? It's showing the rolling 10-year correlations of the performance or the returns of SA equity in rands and the dark green line there is global equity in rands. So it's rolling 10-year correlations, and you see that correlation changing over time there. So if you look at the dark green line, global equity, there has been some increase in correlation. It seems to be slightly more correlated now than it was in the late part of the last century. We should expect this to some extent. A significant chunk of the local market's revenue is actually generated offshore, right? But on the whole, nothing too drastic. It's not too drastic an increase or change. And I say drastic because remember what we spoke about earlier is that more correlation means less diversification benefit, right? And then the maroon line that we see there, global bonds, right? Its correlation in rands to South African equity in rands. As expected, it comes across as a good diversifier. You're seeing more recently that negative correlation to South African equities in rands. So diversifying the SA equity risk quite well there, right? But now let's do this, right? Let's take the impact of the rand out of the global equity returns and the global bond returns, right? So what we're doing here is the dark green line is now comparing SA equity in rands, same rolling 10-year correlations, SA equity in rands compared to global equity in USD, right, in the dollar. So those rolling 10-year correlations, we see that the correlations now go much higher, right? We almost hit 80%, which is pretty much correlated, right? Almost perfectly correlated. And remember, higher correlation means less diversification benefit, right? And if we look at global bonds in USD, and that's again, the maroon line there, this is interesting as well, right? Whereas previously it was almost persistently negatively correlated to South African equity, now it's kind of fluctuating around that zero level, right? So it's a reduced diversification benefit once we strip out the currency. So what's happened here, right? And that blue line that we show there, this is the correlation of SA equities to the Rand dollar exchange rate, right? And we see that actually this is the element that is so negatively correlated to SA equity performance. It's actually the Rand exposure coming through. And it is this element that is perhaps swamping the inherent patterns of global equity and global bonds when we compare those to SA equity in common currency, right? So in a way, the currency itself is a major part, if not, the majority of the diversification benefit of global assets, right? Now, the other argument or standard thinking is, the allure of better returns cited in, investing offshore. So what we're showing here is rolling 10-year returns of SA equity, that's the green line there, and rolling in rands, and rolling 10-year returns of global equity in the brown line there, right? And we can see through time, chops and changes, not much of a clear winner, right? And this is using data going back to the 70s, actually, prior to the 70s, because you've got a 10-year number there. But again, if we remove the impact of the Rand, we see that Rand element has boosted the returns of global equity. And we see that local equity, more often than not, actually provides better returns if you're comparing it to global equity in US dollars, right? You could say that this is rightly so, because SA equity is potentially more risky, more cyclical, and there's more EM exposure, right? And we can look at the same comparison when we look at bonds, right? So looking at South African bonds in rands, which is the turquoise line there, or green, and then looking at 10-year rolling returns for global bonds in rands, which is the maroon line, right? Again, especially more recently, no clear winner in terms of performance. But when you take the Rand exposure out of it, the picture looks remarkably different, right? It's your global bond returns in USD are sitting much lower than the returns that you're receiving from SA bonds and rands, right? Now, the point I'm making here is that it isn't necessarily true that global markets provide better returns than local markets, right? What we see when we analyze the returns in common currency is the boost that a depreciating Rand has given global assets, right? So that Rand, this is what I'm highlighting, is that the Rand is a very big factor in the returns that are received and generated by global assets for South African investors. And then there's, the argument of lower risk, right? Investing globally is potentially lower risk than investing locally. And now, something I've hoped I've showed you by now, right, is that, as I mentioned, returns that a South African investor experience from global assets is significantly impacted by the Rand and what is going on with the Rand. So, and we're all aware that, the Rand can be particularly volatile, right? So what I'm showing you here is the 1-year change in the USD ZAR exchange rate, right? And I've chosen 1-year rolling here specifically because for many more conservative funds or investors, they express this by not wanting to lose capital over a short-term period, usually, a year, a rolling 12-month period. Now, what this graph shows is the impact the Rand will have had over a rolling 1-year period on global assets, right? In the positive areas, the Rand weakening has boosted the returns on global assets by that amount. And where the graph is negative, this is what is being taken off the returns on global assets by the strengthening Rand, right? And as you can see, but if you look at the scale there, the extent is quite substantial both ways, right? You've got numbers easily getting into 20 and minus 20 and minus 40%, and on the positive side going plus 20. So the extent is quite substantial, right? Now, when an investor, the point behind this, right, is that when an investor has a large proportion of assets invested globally, when a South African investor invests globally and the rand depreciates, it's happy days. Those returns on global assets are boosted, right? But equally, when the rand appreciates, returns on global assets can be significantly depressed and can even be negative, right? So you can lose capital in these assets just by the rand being strong. All right. And this brings us to an important point, and it's often an overlooked point, right? You can only preserve capital in one currency, right? So if you're trying to invest with a sort of floor or protection level in mind, trying to invest on an absolute return basis, that level has to be expressed in a particular currency, right? So as soon as you invest in a different currency, even if it's cash in a different currency, you are now exposed to those currency swings, and those currency swings can be quite substantial, right? And it's partly because of this that we found as Macro Solutions in our work at looking at this over many years, that in the more conservative portfolios, the optimum global allocation is much lower, right? Much lower than the current 30% that or the previous 30% that we were allowed to, right? And this is because when you invest globally, you introduced capital volatility through that currency exposure element, right? And there's also an argument that says you've got lower equity exposure in more conservative portfolios, and therefore you need less diversification, and therefore less reason to go invest globally. But the capital preservation aim does require a lower global equity exposure, or a lower global exposure rather. All right. So how are we adapting to the new allowances, and how are we doing taking this into account in our thinking about investments? We use an approach that is a blend of art and science, much like many things, the way we invest, we employ both quantitative elements and a fundamental element to the decision making. So just like many of you, I imagine, we've also pulled out our optimizers and modeling tools when we heard about this, and started trying to figure out, okay, what does this mean, right? The announcement was a surprise. I don't think anyone was expecting it, and to go to Anne-Marie's point, yeah, it has been a surprise, and many people were thinking, half expecting them to roll it back when they realized what they had done, just how much they'd loosened regulations. I don't know if you remember, a while back there was the ETF story, where even a global ETF listed on the local market would be considered local, and they made that change and then they wound it back, right? So people were half expecting them to do the same, but actually no, it was a deliberate change that they did, right? So we probably do a lot of similar things that to how you would approach this problem. However, I think there are a couple of elements where we have a small edge in this regard, and one of those is actually just better data. We've been compiling asset class returns for a long time now. Now it's our kind of, it's our peculiarity. We like looking at returns over a very long period. It gives us, we've got a publication called Long-Term Perspectives, which is entirely built on this idea of looking at the history of asset class returns and what it means to how we can take information and insight from that into investing today. And I think, in that publication, you'll see that we have data going back to the 1930s for most asset classes, right? However, when we do this optimization work, we don't go that far back. We go back to the 1970s, right? And this is largely because of the limitation we have on SA property data. And actually, even saying that it's a limitation, we are probably the only ones in the country to have SA property data going back to the 1970s, because we actually created this ourselves, right? We noticed that the JSE data, as soon as you went back a bit further in history, became a bit questionable. So some time back, an ex-colleague of mine, Adrian Allardyce, who's long since retired, worked with us, and we built this series from bottom-up data of the companies. So using this data for 50 years, we model a host of portfolios through time, systematically looking at what different allocations could be used. And we then assess what we call hit rates, how often the required return of the portfolio is achieved, what were the risk metrics of the portfolios, how much risk was taken. And for more conservative funds, the capital preservation hit rate would be assessed, and that's an important aspect. And we then take the top 2 or 3% of portfolios that have delivered to requirements historically, and we look through these portfolios to assess what asset allocations are working, right? Which ones are the ones that are performing. We do we perform a sense check on the numbers. And this is a more manual approach, but it is actually preferred to, we ideally want to avoid a mechanistic optimization approach that, what we find with those kinds of approaches is they tend to target corner solutions that often throw up odd results. And that's because of some peculiarity of history or a specific period that kind of pushes that particular portfolio. So we prefer this kind of fundamental, more manual approach to finding the ideal asset allocation, right? And through this process, what our preliminary results show is that this is the optimal long-term static allocation for a standard South African balanced fund, right? Like the Old Mutual Balanced Unit Trust. So, how would you interpret this allocation, right? If Macro Solutions knew nothing about the valuation of asset classes, and we knew nothing about the environment asset classes we're facing, what Macro Solutions calls themes, right? This would be the asset allocation that would give us the best chance of meeting the portfolio's goals, right? So the main things to notice here would be, even though global exposure can now go up to 45%, and that was included in the modeling, the optimal exposure sits at around 35%, right? And this has gone up from where we were, which was 30%. So we found that actually going beyond 35%, having more or higher global allocations actually compromised the risk return characteristics of it. Total equity and total growth exposure have stayed the same as previously, 65% and 70% respectively. But 2.5% has moved from SA equity to global equity, and 2.5% has moved from SA property to global property, right? So now, what does this mean for you and your portfolios, and how should you be thinking about global exposure in your portfolios? And the answer is very carefully, right? Most importantly, it's important to remember that if you're using static allocations to asset classes, changing these static asset allocations is an active decision. And as I hope I've demonstrated, this decision will materially impact the returns achieved by the total portfolio. Now, I know many of you will just consider it a benchmark change and only look at performance versus benchmark, but this often hides the fact that the decision was made and it doesn't assess the quality or the timing of that decision. Being able to allocate a larger proportion of assets globally definitely increases the flexibility that our portfolios have, right? But as mentioned, the volatility created by the currency exposures can make this, more rope to hang ourselves with a bad asset allocation decision. I was talking about people and bad timing in terms of going offshore or not. I still remember people asking me in 2006 and 2007, after a long period of strong rand, why should they even bother investing offshore? And obviously that was just before we had a very weak rand. And then, in 2015, 2016, rushing to take money out of South Africa after the rand had weakened significantly already. So taking the decision to move more assets offshore is making a call on global assets versus South African assets. It is making a call on the rand, and it is expressing a view. So that's an important point to remember when you're thinking about it. I can talk a bit to our thinking about, what we're seeing currently and how so this, the static allocation that I showed is what the portfolio would be if we had no insight into valuation or the environment and themes, right? But what do we think of the current environment is that We know there's going to be liquidity tightening. The US is hiking rates, yields should go up. And this is why, in a global context, we prefer global equity over global bonds. In fact, in most of our solutions, we have zero exposure to global government bonds, right? And with this rise in yields, we get usually higher nominal growth. And with that, you should see a rotation out of more growth type companies to value type companies. And given the high levels of valuation in the US companies in particular, we prefer exposure outside of the US. The other problem with high valuations is that it means, for bonds and equities, it means that the level of returns in the future, the absolute level of returns in the future, will be lower. So in that world, SA bonds giving you a 10% return looks quite attractive, right? And other than that, we've spoken about South Africa. We're still you would have seen the news press coverage of Kaya Gwodo mentioning that our portfolios have benefited from a significant exposure to South African companies and SA Inc. That's generated strong outperformance for us. We continue to be invested in there and continue to see strong earnings growth from these companies. But if you look out a longer term, we do think that we have to see some structural reform in South Africa to boost our longer term economic growth potential. Failing that, we have to look at companies that are long-term winners that can win regardless of the South African outlook. There's tons of risks that abound, and the Ukraine war is one of them. Policy error and the Fed tightening too much, or China tightening when it should be actually relaxing, is another one. But when we think about valuations on asset classes from a long-term valuation perspective, we see South African assets offering a lot more value than global assets. In the global sense, global equity is our preferred asset class. Locally, SA property is cheap, but there's potential structural headwinds from high vacancies and poor rental growth. We do have a strong preference for South African bonds in particular over local cash, right? So, if we put this thinking together with that static asset allocation modeling, right, we're seeing better value in SA assets and potential for expensive global assets to struggle. So, you've got more shorter term factors like Russia becoming uninvestable, Turkey's having its experiment with novel monetary policy, China is scaring off investors with regulation, Europe is worried about energy prices, inflation. In the US, the Fed the market is still expensive, and now you've got the Fed hiking. In that context, you look at SA, a commodities beneficiary, which will support our trade balance. Our current account should support the rand, a reasonably stable government that's actually cutting corporate taxes and relaxing foreign exchange controls. These are all the right things to do. SA suddenly doesn't look as unattractive, compared to what's out there. So we were underweight compared to the previous 30% global benchmark in all our solutions. We hold no global bonds. And even with this relaxation, we are not just yet running for the door to trade cheap SA assets with a potentially improving environment into what's likely to be more expensive global assets in an environment that's likely to be deteriorating. So thank you for your time. I'll hand back to Anne-Marie for any questions.
Thank you very much for the presentation. Let me just quickly go to our questions, and I'll first going to go to question and answer and then to the chat box. So the rand has clearly depreciated against the US dollar over the last 3 to 5 years, 10 years. So an increase in US denominated assets should add value to portfolios on a total return basis. Should this entice South African fund managers to increase foreign asset holding?
That's actually an interesting question, because so there's always a danger of backward-looking information, right? So when you see backward-looking 10-year returns numbers, right, that show the rand depreciating has already boosted global returns, what you then need to take account of is, where is the rand now, right? What is the forward-looking perspective on the rand? If it has been depreciating for 10 years, has it gotten to a state where it's relatively cheap? And this is that idea I was talking about, where investors rush for the door after the rand has been weak, and then don't want to invest offshore after the rand has been strong. That's actually the opposite of what they should be doing. So after a period where a depreciating rand has boosted global returns, you actually want to invest more in South Africa. And after a period where the rand has depressed, strong rand has depressed global returns, that's when you want to invest offshore, right? So it's a bit of that kind of contrarian thinking, but you've got to be aware of the timing, right? At the moment, what do we think about the rand is that the strong commodities environment means that our, the stuff we export, gold, platinum group metals are supported. Oil is a kind of Achilles heel for South Africa, but our trade balance should still be okay. Our current account should be okay. We're exercising a bit of fiscal discipline, and we're getting this boost fiscally from commodities revenue. So the rand is not in an environment that is totally negative. The Fed hiking is a deterrent, but on balance, we still think the rand has positive characteristics around it. And in terms of valuation, I think we can say it's fair value, maybe even slightly expensive, but not terribly expensive. So we wouldn't be going underweight the rand. We aren't underweight the rand at the moment.
Great, thank you. So what structural reforms are you referring to that could enable economic growth in South Africa?
So, we've actually seen some of this come through, but, the major things we need to see is very much positive regulations and reforms that will encourage domestic confidence, consumer confidence, but more importantly, domestic corporate confidence and foreign investor confidence, right? We want to see things that give certainty to investors so that companies can plow money back into our economy. We're seeing mining companies generate a lot of profits, but as long as there's any uncertainty as to the future of regulations, there's going to be hesitation to invest. When we see, the impact of, the riots that we saw in Natal, very sadly, the one thing it means for the future is that investors are less likely to invest, first, let alone coming to South Africa. Once they decide to invest in South Africa, are they going to choose Cape Town, Joburg, or Durban? It's unlikely that they're going to choose Durban. So it's reforms like that. It's, to an extent, labor reforms, where we make it easier for companies to invest, to start businesses. That process of starting a business, undoing the red tape, making that process more efficient. Those are the kinds of things. Then obviously the major one, right? Electricity. I haven't touched on that because, everyone knows it, but we have to get electricity production running smoothly. So those are the kinds of things that we think about.
Thank you so much. I see that there's also just a mention around your comment on the JSE, and the data that's not going back too far. Is it something that the JSE need to fix? Can you elaborate maybe on that comment?
So no, this is very much historical data going back into the 90s and prior to that, where so it's not a current problem for the JSE, but it's about their data off the history. Yeah,
and the fact is that you have the data that you can work with available at the moment, so it should not actually affect any decision making necessarily. I wonder if there's anybody that would like to, as a final option, maybe pose a direct question. If you can raise your hand, we can take some direct questions as well. I don't see anything, and we're already a few minutes over the time. So thank you very much, Urvesh, for helping us today and to unpack and in such an eloquent way. I must say I really enjoyed the session as well. Lots of good information, and we are welcoming you back soon again, because this is the start of a conversation. It's still very new, so I'm sure that people will go back to their boardrooms and say, but I need more information about this or that or the other thing. But thank you very much for spending time with us today, and we will see you very soon, hopefully.
Thank you very much for the opportunity, Anne-Marie. Thanks a lot.
My pleasure. So, colleagues, we have our next session in, I think, another 15 or 30 minutes or so. It's about umbrella funds. So we also want to invite you to join that session. And then I just want to make a few announcements. Any principal officer or trustee that is interested to do the trustee qualification through the recognition of prior learning program, or principal officers and trustees, it's both of them, please contact our office for application forms. We do have a number of bursaries available that you can use to the value of about 10,000 Rand. So if there are any principal officers or trustees online now and you are interested to do the RPL program, please contact the office. And then I've also asked Bianca to just share with us, Bianca, quickly some of the communication we received this morning from the FSCA. I think there was a survey on unclaimed benefits that they have withdrawn. It's not necessary to complete that. They will reissue. And then there's another survey that they've done on communication or complaints management that you will be on the lookout for. I see here on the chat box, you can send a email to sharon@batseta.org.za should you need information about the application. Thank you very much. I'll hope to see you soon. And then the umbrella session, I think, Bianca, does it start 2:45?
Yes, Anne-Marie, that's correct. 10:45.
10:45. Yes. Thank you very much and have a great morning. Goodbye, everybody.